Recessions can be a great way to build real wealth, but it can also be extremely scary to have money in the game when everything is plummeting to the ground. This is why it is very important to have a strategy for when everything is crashing. Don't panic and sell out during the downturns. Look at it as a possibility to buy cheap assets. But I get it. It can be scary when billionaires, analysts, and economists warns us that a financial crisis could be just around the corner. Warren Buffett have raised concerns about speculation in the housing market. Michael Burry, the famed Big Short investor, is betting $1.6 billion that the stock market will crash. Even Barry Sternlicht, one of the most respected real estate investors globally, is predicting an economic hurricane. It's no wonder that 70% of Americans think a recession is looming. But how do you prepare for the next recession? How can you not only survive but benefit from the next financial crisis? How do you ensure that your financial position improves, even during tough times? We're going to answer these questions and show you 7 investing secrets that can create massive returns during a recession. 1. Never abandon cash. When financial times get tough, cash is your safety net. When the economy is booming, it's tempting to pour all your money into investments like cryptocurrencies or trendy digital assets. But as soon as there's a hint of an economic downturn, even the wealthiest people start selling off riskier assets to hold more cash. Take Warren Buffett, for example. While he's known for investing in high-quality companies, he also keeps a lot of cash on hand. This cash is crucial for taking advantage of opportunities that arise during downturns, like buying quality stocks at a discount. So, how can you prepare for a recession? Start by cutting back on unnecessary expenses. Even small daily purchases, like a cup of coffee or a pair of new sneakers, add up over time. With inflation driving prices higher and ongoing supply chain issues pushing costs further up, every dollar saved can make a difference. Stockpiling cash now could provide a significant advantage when the economy eventually slows down. It's not about becoming a financial expert, but about being smart with your money. Even in uncertain times, your financial stability is in your own hands. 2. Invest in liquid businesses. During a recession, many businesses face challenges, and some may even go bankrupt. When employees have bills to pay and families to support, struggling companies find it difficult to stay afloat. Look back at the 2008 financial crisis. Big names like General Motors, Chrysler, and AIG teetered on the edge of bankruptcy, only surviving due to government bailouts or takeovers by more stable firms. That's why it's crucial to invest in companies with strong cash reserves, often referred to as liquid businesses. Companies like Apple and Microsoft keep large amounts of cash on hand to weather tough economic times. They prefer to hold on to cash, even if inflation erodes its value, rather than risk running out of funds during a downturn. To determine if a company is financially stable, review its financial reports, particularly its balance sheet, to see if it has a cash cushion. Keep in mind, though, that not all companies will be as cash-rich as tech giants like Apple or Microsoft. 3. Recessions can be opportunities. Contrary to popular belief, a recession might be the perfect time to start a business. When the economy is booming, it's tough to compete with established companies. But when the big players are busy managing their own downturns, opportunities open up for new ventures. Take WhatsApp, for example. It was founded in 2009, right in the middle of the financial crisis. A few years later, Facebook bought it for an astounding $19 billion. Now, with over 2 billion users, its value has soared even higher. Similarly, Uber was also launched in 2009 and is now worth nearly $50 billion. Other successful startups that began during the recession include Pinterest, Venmo, Slack, Square, and even Bitcoin. The 2008 financial crisis inspired the creation of Bitcoin, which has since sparked an entire industry and turned many early investors into millionaires and billionaires. But it's not just about starting a business. A recession can also be a good time to level up your career. When things get tough, stepping up at work can help you get ahead faster. Many junior managers were promoted during the last crisis when companies needed strong leadership. Tough times often create opportunities for those who are willing to step up. 4. Don't cash out in a panic. It's easy to stay patient when your investments are growing, but during a bear market, when stock prices plummet, many people panic and sell off their assets, thinking the market will never recover. The truth is that financial markets, like the stock market, have survived every major crisis, from the Great Depression to the 2008 financial meltdown. The investors who profited the most were the ones who either managed to sell before the crash or, more realistically, held onto their investments and waited for the market to recover. Trying to time the market is nearly impossible, but staying invested during downturns can pay off in the long run. 5. Embrace the gig economy. Traditional jobs can be hard to come by during a recession. However, the gig economy, characterized by freelance work and short-term contracts, often thrives during tough times. You can offer your skills and services online, whether you're a writer, graphic designer, web developer, or have expertise in another field. There's a growing demand for freelance work, especially when companies are looking for cost-effective, on-demand solutions. Even if you're not an expert, you can start by offering services at a lower rate and gradually increase your fees as you gain experience. The key is to diversify your income streams. The gig economy can provide a recession-resistant source of income and flexibility in an uncertain job market. Platforms like Fiverr and Upwork are excellent places to start if you're looking to explore this opportunity. 6. Avoid debt. If you're not prepared for a recession, you could find yourself in a tough spot financially. Many people go into debt just to meet their basic needs during an economic downturn. But if the recession is triggered by inflation or a financial bubble, interest rates will likely rise, making debt much more expensive. For instance, during the 2007 housing bubble, the Federal Reserve raised interest rates to 5.25%. During the dot-com bubble in 2000, rates peaked at 6.5%. Higher interest rates disproportionately affect those who are already financially vulnerable, while the wealthy, who have savings, can take advantage of low asset prices. Avoiding debt can help protect you from the high costs of borrowing during a recession. 7. Consider precious metals. When the economy starts to wobble, many investors turn to precious metals like gold and silver. These assets tend to hold their value when other investments struggle. Gold and silver are attractive because they have inherent value. Unlike stocks, bonds, or cryptocurrencies, they're not tied to the performance of any particular economy or company. Investing in precious metals can be as simple as buying physical gold or silver or purchasing ETFs or shares in mining companies. These investments provide a hedge against inflation and economic instability, making them a smart choice during a recession. Final thoughts. A recession can seem scary, but with the right strategies, you can not only survive but also come out ahead financially. Save your cash, invest in liquid businesses, explore the gig economy, and consider adding precious metals to your portfolio. By taking a thoughtful and disciplined approach, you'll be better prepared to weather any economic storm.